Welcome to Clarity in a Messy World, the podcast that looks at the causes behind the most confounding issues of our time. I'm David Wayne Callahan. In every episode, I'll be speaking with experts who will share their knowledge and insights and help us to untangle a seemingly chaotic world. Clarity in a Messy World is a production of Bocconi University, Milan, in collaboration with the Bocconi Student Media Center. Have you ever wondered what leads to a financial crisis? While much has to do with absence of regulation or unanticipated events, there might be another important, often overlooked factor: human beings. Could it be that human psychology and its biases are to blame for financial crises? Joining us today is Nicola Gennaioli, full professor at the Department of Finance of Bocconi University in Milan. Professor Gennaioli earned his PhD at Harvard. Before settling in Milan, he also taught at Harvard, at Stockholm University, and in Barcelona at the Graduate School of Economics and Pompeu Fabra. Along with Andrei Schleifer from Harvard University, he co-authored the best-selling book A Crisis of Belief: Investor Psychology and Financial Fragility. The book takes a look at the Great Recession of 2008 through the lens of behavioral finance. Nicola, thank you so much for joining me today.
Thank you for having me on the show.
Nicola, as you might have figured out by my last name, Callahan, which in fact was O'Callaghan, I have partly Irish origins. Now, you have a favorite anecdote about Irishmen and red hair that you use as a metaphor to explain an important concept in your work. Can you share it with us?
Sure. The question is, what is the hair color of a stereotypical Irish? Now, you can ask around and you'll see that many people say red. The stereotypically Irish hair color is red. Now, the question is why? You might argue, well, maybe many Irishmen are red-haired. Well, that's not the case. You may be surprised. Only 10% of the Irish have red hair. So why such an unlikely stereotype? Well, it turns out that the key to understanding this is to note that red hair is much more frequent in Ireland than elsewhere. Approximately 10% of the Irish are red-haired, whereas only 1% on average of inhabitants in other countries are red-haired. So red-haired is distinctive of the Irish, and that's why it's the stereotype for the Irish.
I have black hair. I think I would feel more Irish had I had red hair. In your work, you argue that this is useful when thinking about financial instability and financial crises. Why?
Well, we actually argue with my co-author, Andrei Schleifer, that this is relevant for understanding, a broad range of so-called biases that people have when forming their beliefs in many domains, not only in financial markets. In particular, and this is kind of the set of broad lessons that this simple example teaches, is threefold. The first is that stereotypes come to mind very quickly, and it's harder to disregard them. When I asked about the hair color of the Irish, I'm sure you immediately thought about red-haired. The second thing that this example tells us is that stereotypes have structure. They reflect aspects of reality. It is not a coincidence that the stereotype of an Irish person is red-haired. It's just that that trait, it's more frequent there than elsewhere. It's more frequent in Ireland than elsewhere. So there is structure in the stereotypes. And third, it's the important consequences that this has for our behavior. It can lead us to overstate the probability of certain unlikely event. As you think about the Irish, the idea that the person might be red-haired immediately comes to mind, blocks us thinking about other possibilities, and so we might end up estimating the share of red-haired Irish to 20% or 30% rather than the more realistic 10%.
To go back to your original point, what do these three properties of stereotypes tell us about the world in general?
Well, overall, what this example tells us is that first, we don't form beliefs perfectly, as rational theories would like us to do. But it also tells us that our beliefs are not wholly arbitrary, as a superficial perspective on psychology and its influence might suggest. What it tells us is that our beliefs are based on reality, but stretch it, overweight its distinctive aspects. And it's this overweighting that causes us to make mistakes. As we show in our work, which is often in collaboration with Pedro Bordalo from Oxford University, this approach to belief formation can help explain our opinions in many domains. Think about politics. In politics, we have to form opinions about the supporters of different political parties. And here, once you focus on the distinctive trait of each party, you might end up exaggerating political polarization, having a sense of us versus them. And this is something that recent work with my Bocconi colleague, Guido Tabellini, is actually showing. But you can use the very same idea to think about social groups based, for instance, on gender or on race. So think about yourself as having to hire for a job an applicant from, say, a minority group. Now here, what we show with Katie Kaufman from Harvard is that the stereotypes that distinctively come to mind when you think about the distinctive traits of these minority groups can create strong discrimination. And then, of course, and this is the main topic of today's discussion, is financial markets, when we need to form expectations about the future profitability of a firm or about the economic growth of an entire economy. Here, this very same mistake, as I hope we can discuss later, can help you understand financial instability and crisis. So the very same belief issue can shed light on many different domains.
And exactly what you're saying connects to a broader theme. Traditional economic theory posits humans as rational agents, but in the last 2 decades, the Nobel Prize for Economics has gone to scholars such as Daniel Kahneman, Richard Thaler, and Robert Shiller, whose research shows that humans are not that rational after all. Can this way of thinking still be considered revolutionary?
Well, these are great scientists. They've made path-breaking contributions to psychology, to economics, and to finance. And they have done so by unveiling many anomalies. What is an anomaly? It's a fact about human probability judgment, the behavior of consumers, of prices in the stock market that is hard or even impossible to explain if people make the best possible use of their information. Anomalies are suggestive of mistakes. And so by unveiling these anomalies, Kahneman and his co-author Amos Tversky, and then after them Dick Thaler and Bob Shiller, have created entirely new fields of research and methods of investigations that put psychology center stage. This approach has proven extremely useful to explain many things, and much more is ahead in terms of exploiting its potential. So yes, I think that's a revolutionary way of thinking.
And Nicola, what is the upshot of your body of work specifically in behavioral economics?
Well, the work that with my collaborators we have tried to do says, look, here are these many anomalies that we've learned about, and so humans can be non-rational in many possible ways. But so, is there some order to it? The title of your program is Clarity in a Messy World. There is a messy forest of many anomalies and many biases. In our work, we try to understand whether we can connect the different trees of this forest, the extent to which different biases can be viewed as manifestation of a small number of cognitive mechanisms. And it's early to tell, but the results look encouraging. In particular, our work underscores the importance for thinking about many biases of two basic cognitive frictions, which are memory and sensory perception.
And Nicola, I've got to tell you, just in working on this podcast and in speaking with you in the preparation, I've been thinking myself about biases. And I mean, you don't realize you're being biased. They're just thoughts that kind of pop into your head, no?
That's right. That's a very important idea of our work, that, these biases are involuntary, they are quick, fast, and they reflect a memory mechanism that is called interference. When something pops quickly to your mind, interferes with recall of other perspective, other aspects of the problems, and then you end up making an unbalanced decision.
Mm. And what does this imply for understanding human behavior in general?
Well, this means that selective recall, it's an important gateway to think and unify many different biases. We have a lot of information in our head stored there, but we don't freely retrieve all of it to use at a given point in time when we need to form an opinion. Recall is selective. And so thinking about that selectivity is crucial to think about many different biases. And the second is that the same selection goes on in terms of perceiving parts of the environment. We don't take all the information in front of our eyes to the same account. We overemphasize salient aspects of it and neglect the rest. And the key point is that there is a psychology structure in this. There are regularities in memory and sensory perception that tell us what is our mind drawn to, what is our perceptual apparatus drawn to, and these can be used to organize a systematic investigation on biases, and so to put some clarity in a messy world.
In one of your books, you define the financial crisis of 2008 as a crisis of beliefs. I'd like you to explain what you meant by that, and can you also tell us how this connects with psychology?
Yes, a crisis of beliefs captures the idea that before the summer of 2007, which is the time when we learned that something was wrong in the financial sector of the US, at that time, or before then, investors were excessively optimistic about the future. And we can say that because we did, a pretty extensive task of collecting and analyzing lots of data on the expectations of households, of investors, of the managers of firms, and of policymakers. And once you look at these expectations, at the forecasts that people make for future economic states, you see that right before the crisis, there was a strong, systematic over-optimism across the board about things like future corporate earnings, economic growth, future stock prices, house prices, etc.
It seems almost counterintuitive. How does over-optimism lead to a crisis?
Well, the idea is that when investors, when households are over-optimistic, they take too much risk. For instance, they borrow too much. And this implies that when the subsequent economic reality turns out to be worse than what they expected, they can no longer repay their debts. So what this implies then is that a crisis is not happening because there is a meteorite falling from the sky. It is happening because the over-optimism during good times has caused an over-expansion of the financial sector. So the basic lesson is that it is the good times that lay the seeds of the crisis.
And the alternative, rational explanation of financial crises is that they're like black swans or perfect storms. They're unpredictable events that occur because of the rare combination of many unlikely events. In your view, what's the problem with this approach?
Well, I think this approach has three problems, okay? The first one is that financial instability occurs way too often. I mean, it's not always of the devastating kind of 2008, okay? But even if you take recent US history, you have the collapse of the dot-com bubble in 2000, you have the stock market crash of 1987, you have the savings and loan crisis of the 80s, I mean, not to mention the Great Depression if you go back to the 30s. Now, there are just too many black swans. You see, why don't we get accustomed to that? Why don't we just expect them to happen more frequently? You know, they're too frequent to be exceptional events.
Yeah, in fact, they've come to be called corrections of the market, no?
That is right. I mean, that's the way we see them. We see them as systematic correction of the market. And, you know, this brings me, in fact, to the second reason why I think the rational approach to crisis is problematic. The second reason is that it's becoming more and more clear. There is a lot of empirical work that's been done showing that there is predictability in financial crisis, in the sense that, just as you said, market correction, financial crisis tend to happen after good time, after expansion. If you go through periods in which a certain asset class, it could be housing, it could be stock, it could be corporate debt, you know, the valuation of this financial asset grows very fast, and then there is a lot of expansion in issuance. After those time, it is more likely that you have a financial crisis, that you have a correction. It's not that the crisis happens for sure, but the probability of it occurring after those conditions is higher, which is inconsistent with the idea that crises are just unpredictable black swans. And the third reason why, you know, I think the behavioral approach to crisis is more realistic, is more persuasive, is that, you know, it actually connects to the predictability, and is that you see it in the beliefs data. If you go out and measure what people think, what people expect, you see that these data of what people think and expect helps you predict movement and correction in stock prices. And so you see that the crisis and beliefs, the crisis and the over-optimism in beliefs are directly connected. This is a very different world from one in which rational investors get unlucky.
In this respect, did the financial crisis of 2008 differ from the crash of the dot-com bubble in 2000?
Well, one interesting thing about this comparison is that the two crashes entailed financial losses of similar magnitude. Where they differed fantastically is their macroeconomic implication. There was hardly a recession in 2000. We experienced the Great Recession after the 2008 crash. And the reason for this difference rests on the specific asset class about which investors were over-optimistic at the time. In the 2000, it was internet companies that everyone was excited about. In 2008, it was houses. And what's the difference? I mean, why is this different is important? Well, because everybody owns houses, including banks, which means that when house prices crash, the entire system, and banks in particular, get in trouble. Now, one interesting psychological aspect here, okay, that also draws a distinction between these two crises, and is related to what I was saying before, is that stocks are risky. Instead, we tend to perceive, and generally speaking has been true, that houses are safer than stock as an investment. So the crisis of 2008 was devastating also because it was very unsettling. It affected people who were very intolerant to risk and had decided just to invest in a house to protect themselves. The crisis led them to believe, well, nothing is safe. I mean, maybe only the government is safe, but what's left out there to invest safely in?
And even professional investors seem to be prone to this kind of behavioral bias. I saw your provocative video, Nicola, in which you recommend investing in shares that analysts were most pessimistic about, because according to a study that you had carried out, such shares yielded 12% more than those shares in which they were most optimistic.
I wouldn't say it's provocative, or it did not mean to be provocative. These facts were already... The facts are not new in the sense that our co-author, Rafael Laporta from Brown University, documented them in his PhD thesis in 1996. So we started by checking, Rafael was also part of the team. Is this continued to hold? We saw yes, it held until 2014. And the precise finding, just to, be specific, is that firms that are expected by analysts to display in the future the strongest profitability turn out to be disappointing investments. So, it's not that these are firms that do poorly in terms of generating cash flows, in terms of, selling their products. These are firms that might be doing well in that dimension. They might be good businesses, but they just turn out to be poor financial investment. You get low stock returns if you invest in them. In a sense, this is similar to a financial crisis, okay? There are good news, maybe about a firm. You get too optimistic about it. It's not that the firm will turn out to be a disaster. It's just that its stock price is too high, and so there will be a correction subsequently. And again, the idea behind this, I said that with the idea of stereotypes, you can, rationalize many of these things in a parsimonious way. The idea is that, like the Irish red-haired or the other examples of stereotypes, there is an aspect of selective recall into this. And this can be seen in the data. So if you take these firms that the analysts are most optimistic about, okay? In a given year, you just look at them and you follow them in the subsequent 5 years. Okay, you will see a distribution of outcomes. Some of them continue to do well, other, do average, other do poorly. But what is remarkable about this distribution is that there is a tiny fraction of them that is really exceptional. These are the Googles, these are the Amazons. These are companies that started small, grew very fast for a while, and continue to grow. Okay, so once you think about firms analysts are optimistic about, what you think is that they might be the new Googles, the new Amazons. Now, it's true, among those firms, there is a higher share of exceptional firms, but these are very rare. It's like when you think about the Irish, it's true, there are more red-haired people there than elsewhere, but it's still only 10%. And so the problem that this paper highlights, and this finding highlights, is that, again, you emphasize the distinctive trait, the exceptional firm that comes to mind, you become over-optimistic, the stock price gets inflated, and then you have a correction. So the same problem that explain stereotypes and biases in many domains also help you explain disappointing stock returns.
Now let's talk about the COVID crisis that has so dramatically touched all our lives. In addition to those facing sickness and death or managing the care or the loss of loved ones, many have lost or drastically reduced their employment and income, and others work exclusively from home, or perhaps we can also say they're living at work. Older generations have described the deprivations of this COVID era as similar to those of being at war, living in anxiety, shut in, having to respect curfews, and being unable to enjoy the usual pleasantries of community life, modern entertainment, socializing. If it's not too soon to tell because we're in the midst of it, what behavioral biases can you single out in this current crisis?
Well, that's a tough question in the sense that the current pandemic is a unique event in many respects. And when it comes to beliefs, two aspects are really important. The first one is that for most of us, virtually for all of us, there's no prior experience. We have no memories of past pandemics to draw similarities with. So this makes it very different, to think about the pandemic than to think about regular companies or known social groups or nationalities for which, we have experiences. In the context of the pandemic, there are no memory anchors to think about it. The second important aspect of the current pandemic is that it is an exceptionally large and dramatic event with huge and perhaps unprecedented media exposure. So surprise here and attention to the events is possibly a crucial component of how we actually react to this. And we were curious about, this unique episode. And so with Andrei Schleifer and other co-authors, we decided to run, in the spring of 2020, to run a large survey asking a representative sample of US residents about their beliefs about COVID health risk and other questions, but mostly COVID health risks, what their perception was. And a preliminary look at the data reveals these two patterns. Now we've run 3 waves, March, July, and November, and we just got the last, batch of data, and we're starting to analyze it. Now, if you look, at the data, there are these 2 patterns that stand out. The first one is that there is a striking age gradient, okay? And this is that young people are much more pessimistic about the lethality of COVID for themselves than the elderly are. Now, the medical data tells us the opposite, that COVID is more lethal for the elderly than for the young. If you look at beliefs, the opposite is true. The young believe that it's more lethal for themselves than the elderly believe for themselves. The second fact that we unveil in this looking at the data is that people living in regions that saw the fastest increase in COVID deaths over the previous few weeks are much more pessimistic about COVID and COVID health risk than people living in regions where the increase in the death toll has been recently slower. Now, this is suggesting that kind of these beliefs about COVID go up and down. You see, when cases rise, people get pessimistic, and then when cases fall, people become less pessimistic, even though there is a stable mortality rate in the data.
I can wrap my head around the idea that people living in high COVID death regions would be afraid that it's more lethal because it's what they're seeing. How would you explain this phenomenon of younger people being more afraid of the lethality than older people? That seems strange.
That's very strange. We are kind of thinking about this now. We're trying to understand why that's the case. It seems that attention here, and I mentioned the idea of surprise, can play an important role. And the idea is the following. For the young, think about COVID as a shock that makes, the risk of death prominent for society as a whole. Now, you have to ask yourself who is more affected by this shock, who is more surprised by this shock. And so one possibility is that for the young, it is quite shocking and unusual to entertain the possibility that he or she may die soon. And so the young are avid consumers of COVID news. They use a lot the social media. They look at the statistics or they talk among themselves about this unprecedented event. So the risk of death might be very prominent for them. And so they might be very pessimistic. For the elderly, the things might be different. For them, it might be more normal, more natural to think about the possibility that they may die. And so, yes, COVID is, a seizable risk for them. Yes, COVID is prominent for them, but less than for the young, which is why they are relatively less focused on it than their younger, friends, and that is why they turn out to be less pessimistic about it.
Nicola, thank you so very much for being with us today.
Thank you. The pleasure was mine.
I'm David Wayne Callahan, and this has been Clarity in a Messy World, a podcast from Bocconi University, Milan. Thanks for listening. You can find references from this episode in the podcast notes. To be notified when new episodes come up, subscribe to Clarity on Apple Podcasts, Google Podcasts, Spotify, or Spreaker.